Is the stock market currently in a bubble? Well, we're going to look at this in some detail today, and I want to spend some time on this. So here we are in 1929. And what I find so fascinating about these times is you can see, obviously, these runs up into it. And this is about as far back as I can get with data. But we look at these little pops over, and then we look at these crashes, and we all talk about this. But let's just put it in perspective. You're at 31. Okay, so you lost 87% of your value. In what period of time? You lost 87% of your value in 34 bars of trading and 34 months of trading, because we're at months. Stay with me. No one really ever talks about what happened in the early 70s, but you can see here as well, for 18 months, we lost 50% of the value in the S&P. It's like everything else. Turkey has a great life until the day of Thanksgiving. If you look at 87, because everyone likes talking about a market crash, you lost 34% in a month. And we're looking at the month for a reason, and we're going to tie this all together to what's going on with AI right now. Is it a bubble? Is it not a bubble? What do we do about it? Because when we first look at this chart, as we go through this, and we're setting up for where we're going with this today, and this is going to be packed, and you're going to want to watch a lot of pieces of this over again, in my opinion. But let's go through this. So in 82 to 87, should you have been worried? No, you didn't have a problem or a care in the world, did you? And if you really look at that, I think that's very important for us to get. Now, when I start here, and I'm just going to clip this out for a second, I want you to look at 95 to 99 and where you're at, and we're going to get there. But we had a little problem here, and that problem came from Russia. We may get into that, we might not, but I want you to just watch this for a second. So if you're at 95, this is where we cut rates. And we all know that if we're on Twitter, that cutting rates is bad. All right, since Greenspan cut rates there in 95, what happened to the market? Well, we went up 144% by 99, and we all know what happened from there, right? We all know that it did continue to push, and then eventually what happened? It came in, and it came in pretty hard. Why do we care about this with where we're at right now? Because if we don't look at the past, you're doomed to repeat it. So we have to understand what happened in the past so that we don't repeat it. But what we don't want to do is constantly scream the words that there's something out there that we have to worry about. Meaning, why are we concerned about something if we don't need to be concerned about it yet? What actually brought us down here is probably something that's going to bring us down again with AI. But when is that going to happen? And in and of itself becomes the real problem. Because if you're back here with the first rate cut and you think that that's your problem, or you're back here in 96 when someone gave a speech, which we're going to look at in a second, well, that's going to present a problem for you, isn't it? And so what we're starting to see here is these little blips where we come down and then wind up rallying again. Well, they put us in a position where we think we know what's going to happen, but we don't know what's going to happen. We only think we're going to know what's going to happen. So are we in a bubble? Are we not in a bubble? And let's just take a second here. If we look at what's going on here in the S&P from March 20, which is the high, and all we kept hearing about is, oh, this huge crash, this dot-com crash. Okay, well, yeah, we did come down, and we did come down by March, and in a year, you lost 30% of the value. Did you have time to get out? Did you have any time to get out? And the answer is, not only did you have time to get out, but you had time all in here to trade it. And I should know because I was trading it then. What's important about this is what you think is going to happen versus what is going to happen are two different things. It always is. And I want to preface the beginning of this video with this. And the reason for that is because I've seen this time and time again in trading. When you're here and you're trading and everyone's buying housing stocks, and you'll hear people in here talk about the great housing bubble. Well, if you cared about the great housing bubble and you got out of the way before the bubble actually burst, and everyone always talks about Schiller's piece in 2005 on the great housing bubble. All right, you missed 30%. And so, yeah, you may have been right when it happened. Yes, you could have taken signs of that, but knowing what to look for is half the battle. What you don't want to be doing is thinking that you're in a bubble here and the bubble doesn't really end for another 6 years.
But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade?
Okay, so in 96, that was the speech, irrational exuberance. And what we learned during that period of time was that we think that we know what we're doing, but we really don't have a freaking clue. And this is really important to get. So by the end of this, what you're going to understand are a couple things. One, what I think happened last week in the market. Two, where I think we're going into the end of the year. Three, you're going to learn what earnings I thought were really good last week and what charts you should be watching in the week ahead. But there's a more 34,000 foot view that you need to get here. And that view is really important for people to get. So I want to just go through real quick how I view the market, and then you should view the market however you want. But I think the market is probably the most inefficient thing out there. And I've always said this, you're going to get an outcome, and this is going to be your outcome. And whatever that outcome is, good or bad, there's going to be one. And then you're going to get participants. It doesn't matter if there's a chart here. I don't have time for a whiteboard. And then out of those participants, they're going to have an expectation. So the difference between whatever the outcome is, for example, you had earnings last week on some names. You had an expectation. Some people thought that SanDisk was going to be a pig, and it turned out to not be, et cetera, et cetera. So you have your expectations, and then you have the outcome. What tends to happen with the market is the further that the expectations are, the further these expectations are from the outcome is where you can make money. That difference between expectation and outcome and what people think is going to happen versus what is really going to happen is called reflexivity. And that's how I view everything. It's how I view every single trade that I do. It's how my entire theory behind the market. It's how I trade. It's how I invest. And it's how I've been doing it probably pretty much for 16, 17 years. I actually started doing it a little bit differently, but that evolved over time. But even in 2000, I may have been doing some of that, not even realizing I've been doing it. But when we look at this market and we try to understand what's really going on out there, I think there's a lot to really try to wrap our noodle around. So I want to start with some basic charts and what's going on out there. And then we're going to dive into this so we can kind of identify if you're in a bubble, and then if you're not in the bubble, and then what you should do about it. Now, before we get into, are we in a bubble? What is a bubble? I think it's important just to kind of go through where we're at on the week. And we'll get into more specific names in a second here. But I really think that we should just focus on this. As always, subscribe to the channel, click all notifications because all this stuff is connected. All week long, these videos are connected. They start on Saturdays. So obviously, we have the control bar from the 10th where we had problems with China. We had obviously a government that is not open here in the U.S. I know not everybody that watches these videos are not from the U.S. But with us shut down, it's definitely weighing on the markets. If we just take a look up here, we can see the pattern. You should be able to see this island reversal. I'll point to it in a second. We undercut, and now we have this, what I would refer to as a hammer. It's not really a dragonfly, but obviously we went to a little bit of excess and the hopes of the government opening up again. This is where we're at. Are we in a bubble? It's going to be a question that at the end of this video that you'll have a good understanding of what you should be looking for to see if you are. What we don't want to do, and we don't want to look at this and not say yes or no. We want to look at this and say, maybe. You always want to say maybe, or you always want to say, no, we're not, but this would be what would tell me that we are in a bubble. So I circled this little area, and this little area is an island reversal. So we broke out, and then we broke and gapped down. Now, it's not a perfect island reversal, and it also exists on the SPY, and we're going to get to that in a second. But are we in this bubble, and is this what a top could look at? That's how a top can be formed. And I'm going to explain why I don't think that it is in a little bit here. But you always want to say, yeah, this is not great. Now, if I do the simplest of things, and I click and just make this just open, high, low, close, the one saving grace you have technically, and we're going to have to go through this technically, fundamental, and as well macro, because that's really how you should be determining all of this. And if I look at this, we truly did not gap down. In other words, it's not technically a perfect island reversal because it didn't break below this as this one was above it. So technically speaking, it's not, but it's still there and we have to be cognizant of it. What we really want to know and pay attention to is going to be this one level, the October 10th level, and can we really close above that level since we broke it? Or are we going to rally up and then roll right back over? The other level that you're really going to want to watch is that 626. If you follow us every single morning, we start at 8:15. Sometimes I do start later, but we try to start around 8:15. That 626 level is definitely the area that you're going to want to pay attention to. if we do the simplest of things before we go any further, we would note that we hit the 55-day and we bounced right off of it. We've done this in the past, September 2nd, and that date is going to become important later in this video. But we can see real clear here that we hit that 55 and we bounced. These are the facts. We have some kind of island reversal up here, though it's not perfect. We have this control bar that is really controlling everything, got pulled, sucked right back into it. And we have some weights on the market that are out there that we have to pay attention to. If we look at the SPY and we do the simplest of things, we could see the same exact thing. We came down here in October and we held and we undercut the 55 and we bounced right through it and on above average volume. So this usually provides some kind of slingshot action. And again, we have the same island reversal up here. And if we look at this area, what I find so fascinating about it, and we're going to drop this down to the top of that, is these tend to complete, meaning you tend to get your morning star or evening star pattern on them. And what those patterns are pretty simple, meaning this bar, this becomes the star, right? So this is the bar, this star shooting up, and then you usually get to the top of those, and then that morning star or evening star is complete. What does this have to do with bubbles? You want to watch how you act. Are you able to complete the pattern? If you're not able to complete the pattern on a technical basis, on either the SPY or even on the Qs, if you're not able to complete this pattern even here and get back to that 622, you have a problem. And that's how you should view it. That would mean that the market's heavy. It doesn't, you want it to happen in a day or two. The faster it happens, the more strong the pattern is. But if it doesn't happen and you roll right back over and you undercut this, you have a problem. And that's going to be a sign, not so much of a bubble, but that more of a pullback or correction. And there are some signs out there of some things that we're going to want to pay attention to here. But overall, if we look at the market on a shorter term basis, just off the daily, you could see that we were overbought. We've worked that off, and we still don't look great. If you look at this on a weekly, you are still grossly overbought. And every single level of overbought that is here does lead to some kind of correction. And it might take months for those corrections to happen, but it does lead to them. So we have to be cognizant that this is out there. No different than it was on the 21st. And if we go back through time, it's no different than it is up here. You don't know that you're going to get a pandemic. You don't know that you're going to get your first winning and liberation in January here, which is the, Trump 1.0 of the tariff thing. So, well, not so much pretty much the tariff battles there as well. So, and if you keep going through it, you'll find spots like this and you can't really miss them. The divergences are the worst, and the divergences are always out there for us, and we can see them even here. Once you see these divergences, 1, 2, 3, it's just like finding a pattern over and over again. 1, 2, 1, 2, 3, right? And there it is there in July 2011, and you'll see them over and over again. You'll see it up here, 1, 2, 3, and then you're like, okay, 1, 2, 3, there he goes again, yammering on about his, patterns. Do I have that here? Not yet. But I could have that here. And based upon that, we have to pay attention to it. Now, as I go through this, people are going to say, well, you're thinking that there's a bubble. The bottom line with this, and we're going to get into this in some detail in a moment here, you never know if there's a bubble. You won't know until after. But there's really clear indications on what's going on out there. So here's the SPY and here's XLK. And this is what it looked like during .com. And this is where we are right now. So we would have to look at this and say we're at the same level, relatively speaking, of tech outperformance of the S&P. Is that a problem? Well, Yardini has some really good notes on this, and we're going to get to that in 1 second here. But what we would take from this is how similar is 2000 to here? When I go through some of these slides, a lot of it is very different. And we do need to be cognizant of this. But we also have to understand how the similarities in the fundamentals between these two periods of time. To me, and I point this out because everybody looks at this, and you could inverse it as well, but to me, looking at where we are tech versus XLP, meaning what is tech doing on an outperformance basis versus the XLP, it's another way that you could look at this stuff and say, well, we're really much higher than we've ever been in history over, so clearly this is a bubble. I don't tend to view it that way because if you're going through a technological boom, which we clearly are, we're clearly aware that there is new technology out there. The validity of that technology and the veracity which it'll spread, that's always up for debate, but it's there. So when we're seeing something like this, we could say, yeah, this is the highest relative performance tech has ever had over staples in our lifetime, period, end of story. Is that in and of itself make it a bubble? I don't believe that it does. If we take a look at our wants versus our needs, which is a great way of always determining, are we in a bubble and is this bubble cracking? Meaning, am I buying my fancy jeans versus buying soap? We always want to look at this, and it's pretty telling. Let's go to the weekly just to get a better snapshot. So if we see like the rallies here in November 21st versus the corrections down, are we seeing anything like that? No. When did we see that previously? Well, we saw that in January, and then we saw that in February. We'll drop this down to a daily now so we can look at that a little bit better. And we could start seeing the weakness in February in this, even before the market really started deteriorating and we got all that winning. So what we're having here is nothing that even looks remotely like that, right? We would all agree that nothing here looks like this yet, right? Okay. And then if we went through some time periods, we could even see it here, how you tried to rally up in November, failed the higher high, and then came down. One could even overlay RSI with this and see if there were divergences in this ahead of time. And if there were divergences in that, was that something that people noticed? For example, here you are in December, and here you are here. So then when I go and take a look at that now, what are we seeing? Well, I have a divergence, meaning that divergence that solidified that this was a top in January, and that divergence that solidified this top here in November 21st is also solidifying that this might be a top. Okay, well, that doesn't really bode well for this not being, quote, a bubble or a top. So what we always want to do with this is just be cognizant of previous performance and then go, do we have something? Well, it's kind of what it did in here too, isn't it, in 2007? And we're just kind of going through time and looking at this. And all we're doing with this is comparing it and going, well, we did this in 99. And then it kind of came in and then we rallied back up. And then you would see that this high on the RSI was higher than this one, even though it hit a high. And that tended to do what? Mark a top. Now, if you're in the community, you'll know, and you'll note, and I'm bringing this up for a reason, October 7th, I got out of the swing trades. Like we had all these swing trades on and we got out of them. I don't know when the top's in, but I can tell when things are getting weak. And that's, you can always determine that through the breath. What the purpose of me going through all this is to give you the tools so you can start watching this for yourself and start making your own decisions. I look at this and my decision in my head right now is I need to have my antenna up. At the same time, I'm not seeing all of the cracks that I would need to see, but I'm seeing some. And so when I look at things like the S&P versus the dollar, for example, and we're just going to show you this real quick, I see this, and I see S&P versus the dollar is just on an absolute tear. When we understand that the dollar versus gold, you're anywhere near a top in the market. And if you're looking at this from a gold and saying, am I better off buying the S&P or gold? You're at trough levels on this. So is the market overvalued or undervalued? That's a question that's silly because it doesn't matter. The market's worth what people are willing to pay for it, right? But what we're looking at is right now, people are at a trough valuation in buying the S&P versus buying gold. Now, does that change? Probably does change, but everything is relative. So when we look at something like this, which a lot of people are looking at, we have to understand that this dynamic of this chart will change two ways. Gold plummets and the S&P stays stagnant. This will still change. So it's cognizant. Yeah, we have to be aware of it, but what do we do with it? That in and of itself to me is, if I'm trading in gold, I care about this. I'm not trading in gold. So I'm trading in the dollar. So I have to look at what I'm trading at, but I have to be aware of what other people are looking at too. So maybe there is something to this. And maybe if I look at these particular periods of time where this hit a trough valuation, what I would do with something like this is almost turn it into an indicator. Now, above is the New York Stock Exchange and below is the S&P divided by gold. And what I'm looking at is just the breadth. And I'm just going to do a real quick snapshot and then we're going to drop it to a daily. And we look at these areas and say, well, did this matter in June 2008? No, but nothing mattered because you had all-out panic in the financial global system. So, panic and greed trump everything. And when they're at those extreme levels, nothing and no rationality makes sense. And that's good for investors. Now, if we take a look at '09 and we see what happened here in '09, well, that's perfect because that gives us a baseline. So whenever we have an extreme level and you have a baseline, whenever you have an extreme level and you get a baseline off of it, you pay attention to it. So I have an extreme level and I got a baseline. And look what we get on August 11th, 2 years later. You get a baseline off of this, and that baseline gives you a level that you want to pay attention to, which formed a bottom. If we do the same thing here, and we look at this time in 16, and we're looking at the S&P relative to gold at 16, and above us is the New York Stock Exchange. This could be done better, but we're going to just do this unedited and rock and roll with it. If we look there, well, that's exactly where we stopped during the pandemic. Well, that's pretty interesting, isn't it? If we take a look here, well, that's when we stopped all that winning and liberation, and that's the S&P relative to gold. And then we look and say we're at the same exact spot right now. So then when we flip this back to a daily and drill into this, well, that just happened on the 20th. So this is telling us, based upon this specific indicator that we just created and using it as an indicator, that we're at the same exact level from the pandemic that we are here. Do with that what you will, but I wouldn't blow it off and say that it doesn't matter. When we look at the breadth of the market, we'll note a couple things. We'll note that S5FI, which is stocks above the 50-day moving average, they stopped dropping. Well, that's good. They stopped dropping October 10th. Great. That's important, but we're still on a downward slope, but we did stop. And we've been stopping since Monday, November 3rd. So why do you care about this? Well, for weeks, the breadth of the market was getting worse, not better. And what are we doing right now? Well, the breadth of the market on this week is getting better. And that's important. And it's at that level of the 10th. So that is a good indication. If we take a look at the NASDAQ has one day where it's still made a lower low, but it does look like maybe we hit that trough level and maybe it's going to bounce in here. There's a difference between a bounce and that fundamentally we look like we're okay. And so if we overlay these two, and you guys have seen me do this before, here's the S5FI divided by the NDFI. And what I always like when we're at lows is to mark these peaks. And these peaks over time tend to mark what? Bottoms. This tends to mark a top. And so what people will say is, well, you just said the other graph said this, right? So you have different time frames within those graphs. So in other words, you could have something that is a cyclical indicator or a tactical indicator like this, and you could have something like a secular indicator, something like this, that's telling you what's going to happen over years, where you're looking at something like this that's going to tell you what's going to happen over days. So this is telling me, by looking at this, if we looked at this and used it as a graph, that this tends to mark areas where the S&P is obviously going to outperform. And what do we care about that? We do. We do care about that. The breadth is getting better, but we always want the NASDAQ to lead. So this doesn't bode well for our NASDAQ names. Now, when we look at the market, this is us on the weekly. And what we'll note on the semiconductor index, we're going to get to the details of what's going on in semis in a second here. You'll see we rallied up and then straight down. And we at least did not close at the low. But this is not an area where you should be doing cartwheels when your bars look like that. At best, you get an inside day and you have to work it off. If you look at the daily, we have the undercut and the undercut held right really where a put wall was. And now we can possibly rally back up and complete that pattern. But once again, if we look at the patterns that we're talking about up here, we're getting these island reversals where things broke out. So are we seeing some kind of short-term bounce, or does this continue to hold? It's an interesting question because XLF, we broke the 55, and XLF is financials. S&P does not really outperform or rally until the S&P or the XLF is above that. And a matter of fact, you can go back through any period in history and you'll see it. You literally cannot miss anything about it. So once you start rolling on the 55, and I can clean all this off so that you can see it, but once you start rolling on the 55 on the financials, you're done, you're toast. Once you start getting above it consistently and starts pointing up, you've got a shot like you did here. You can see how it starts rounding here, that rounding period. You're not really rounding yet, are you? But you're starting to. So we have to be cognizant of that because it is something that's important. Another thing that we have to be aware of is that the XLC right now has broken that 55, and this is your Meta, your Googles, your Netflix, and they're not really rallying what we thought they would on those earnings, but Meta we're probably going to get to because they shouldn't really have rallied based upon what they said. But if we see this right here, what do we note? What are we learning from this? Well, I've got a 12 and a 22 and a 55 that are rolling over. So you can't really be feeling warm and fuzzy about that right now. So when we started this video, the whole purpose of it is what? Are we in a bubble? We now have a snapshot tactically of what's going on out there, and you can decipher what you want from that information. I think the best thing to do is define a bubble and how we should be looking at that. And then I think the second thing that we should do is look at some of the fundamentals that are going on under the hood and how they compare going back. And then we're going to just roll into some names that we need to watch next week. Journal of Economic Perspective. So in spring 1990, there was a paper that was published, about 17 pages. You can actually find it on the internet. Just go and grab this, what I'm putting right in front of your face right now, and type it into them internets, and it'll pop up for you. And I just want to go through, it's 17 pages long. I just want to go through the beginning of it for a second and the bottom of it for a second because it's pretty telling. The paper came out after 87 because everybody's saying bubble this, bubble that. We're all in a bubble. Everything's a bubble. And they really hammer home some key points here. And I think it's important to get this because of what we're dealing with right now. And we're going to go through a lot of this today on some data and say, are we in a bubble? Are we not in a bubble? And then think about how we're going to look at this. But the possibility of movements in price could be due to self-fulfilling prophecies. I personally believe that's really what it is. It's fear and greed, and it's that imbalance. And to think that any of this is rational is just a joke, in my opinion. But that is how I trade. If you've listened to anything that I've talked about before, I always talk about reflexivity, and that's really how I view the market. And I think that really it works for me, and that's something that you can look into for yourself. But denotes their dependence on events and extraneous to the market. Yes, bubbles or sunspots. The folklore of such episodes include tulips, South Sea bubble, the Mississippi bubble, increase in equity prices during the Roaring '20s, followed by the '29 crash. And they'll give you other articles in here too. The rise and the crash of stocks from 82 to 87. Now, mind you, 82 to 87, and this is what I want you to take from this. The appreciation of the dollar in the foreign exchange market that peaked in 85. This is why when people say, oh, a weak dollar, and then all of a sudden the market's supposed to go down, right? This is why everyone panics because of what happened in 87. Very different environment. But during this time, from the peak from 85 to 87, the market went a lot higher. So even if you're trading in this environment, if you're not trading, you're going to miss a lot. If you want to sit on the sidelines and wait for a crash, I wish you the best. The appreciation of the dollar peaked in 85. Housing prices increased. Massachusetts have attributed speculative bubbles. The idea that bubble might exist often traced to, I'm just going to go through it, 96 description, equity market as an average environment which speculators anticipate. This is probably the easiest thing to say it. The average opinion expects average opinion to be. What average opinion expects average opinion to be, rather than focusing on the fundamentals of the market. I would argue that when the average opinion is significantly higher than what is actually going to happen, is really when you have a bubble. And until then, you don't have one. The average opinion right now, and this is really important, this is how I view it. You should view it how you're comfortable. The average opinion of AI right now, if you were to put it out there and say 1 through 10 of the average person right now, what would they say about AI? Would they say it's the best, this is the thing, this is going to go up forever? Would the average person think that right now? And the answer emphatically is no. I would say you're at maybe a 4, where if you ask somebody now, what is the average opinion of the internet? Everyone would probably have a 9 with it. I mean, they might not like social media, but they would have a higher opinion that it is something that is going to be around, rather than focusing on the fundamentals of the market. The fundamentals are important to me, as long as the earnings are there. When the earnings slow, that's when the fundamentals change for me. The valuation of those fundamentals on high or low based upon something along the lines of a PE, to me, there comes a part with discounted cash flow where it can get insane. But if you can grow into it, I'm fine with it. And most people should be fine with it because they're your biggest winners ever. The problem comes in when the fundamentals change and the average opinion. That's where you can get what they refer to as a bubble. I really like what he says here. If bubbles exist in an asset market, market prices, assets will differ from their fundamental values. If bubbles exist in asset markets, market prices of assets will differ from their fundamental values. Meaning, if you're running and the market's coming in, you have a problem. Markets would not necessarily be allocated in the savings of individuals' best possible investment use. Thank you, Captain Obvious. Public policies might be designed to attempt to rid the market of bubbles. They do try to do this, and we've seen this in the past. It does not work. I just want to not go through the whole thing, but I just want to show you the end. He walks through this entire 17-page piece, and I would suggest that if you're interested in the equation and how he does it, that you grab it. For our part, what I want you to think about and how I think you should view this is the following. The moral of this section is that research ought to find apparent evidence of bubbles when models work poorly, or when agents expect the future to be somewhat different than history. So what is he saying? He's saying the moral of this section is that research ought to find apparent evidence of bubbles when models work poorly, meaning anything that you're modeling to determine whether or not there is a bubble, when you go through this paper, they all don't work. They all worked poorly. When agents expect the future to be somewhat different than history. All right, so if you are expecting a different outcome than something that happened in the past, that's probably not a good place that you want to be. When you hear the words, this time is different, run away screaming. We think the point presents serious interpretive problem for all bubble tests. We think this point presents a serious interpretation problem for all bubble tests. The current empirical tests for bubbles do not successfully establish the case for bubbles to exist in asset pricing. Nevertheless, bubble tests are interesting, specific tests and should continue to be an important part of the economic. Okay, so we're going to give you this test. We're going to say it's important, but they really judge what's going on there very, very poorly. If you're interested in this, I would suggest that you read the whole paper. Now, are there some signs of a bubble? I'd start here. If I had to say something that does it bother me a little bit, and yeah, this does bother me a little bit. And I think that you're better off starting with the things that are bothering you, and then we can kind of build on it and kind of go from there. And I'll explain this chart. So this is Yardini. A lot of his stuff, actually, you can find free, but his research is just fantastic. I've been reading his stuff for decades, and it's definitely worth it from a much longer perspective. You know how we always talk about the market? You have your tactical, your cyclical, your secular. This would be secular. That's how you would view this. You're not going to act on it on a Tuesday, but you're going to want to know what's going on out there in case you start to see some cracks. And I do think that this is interesting. So you have a forward PE here, and the forward PE, if we look up here, is at 25. The price earnings. And you can see that that PE is roughly the same price. S&P semiconductors. So the PE is here and the semiconductor PE is here. So let's say that again. The S&P forward PE is here and the semiconductor PE is here. So when we're seeing PE, we have to understand what PE is. PE is just price and earnings, right? Why is that important? Because how much are you really making? So we're starting to get into that area where the PE is not really commensurate, or the earnings and price are starting to sway a little bit. Well, how so? Well, the earnings are not really keeping up with the way the price is moving in semiconductors. Now, if you go to 20, when they're closer together, it's the disparity between the two that puts them at risk. So if I had to say, where do I think that we're most at risk? I think you're at risk in some of these semiconductor names. And for me, it's hard to kind of wrap my noodle around. Why? Because I really like the names, and I think the bigger names are still kind of undervalued. I still think that way about NVIDIA, candidly. But some of these others to me, such as AMD, and I tease people about it, but when you're growing at 25% and you're trading at like a 50 PE, and you're looking at this kind of thing, and the PE is actually worse than that. But when you're looking at this, it starts to scare me a little bit. Not a lot, but it's a problem. What needs to happen is the earnings really need to kick in here. And if you start thinking about it from a CapEx standpoint, you'd have to ask yourself, like, what are the next deals they're going to announce? $1 trillion deals? Right? We already have OpenAI out there saying they're going to do $12 billion in revenue, but somehow they're going to spend $1 trillion. And everyone's trying to figure out how they're going to do that. So when you're closer together like this, you're like, all right, well, it does make sense to buy semiconductors because they're outgrowing the PE, because you also have, your growth rate. But when we have these disparities between the S&P forward PE, which is here, and then we look at something along the lines of the S&P semiconductor forward PE, that's fine if the growth is there. The disparity between the two is where I start to have concern. Is the growth there? For some names it is. For if we start looking at the DRAM, storage, memory space, they're on fire. And so we're going to have a group that's going to get left behind. So I think you need to be selective with semiconductors more than anything. Now, in this graph that goes back to 96, back in the day, what you have is capitalization shares, and then you have forward earnings shares. And what you're going to see, and I thought this was worth talking about because of what we just did with semis. So information tech plus communication services. And then we're going to look at the market cap versus the earnings. And they do it on a weekly and they ratio it. All right, cool. So if we go back to the bubble, that everyone loves this bubble, and we talk about the forward earning shares in relation to the bubble. So if we look at forward earning shares, you're roughly at what? You're at like a 24, we'll call it. And then you're up here at like a 40. Yay. And then we kind of look where we are now. And you realize that you're at like a 36, let's call it, and you're at about a 42. And everyone's like, oh, the capitalization of these names, it's the highest it's ever been. Well, on the information tech side with communication services, that might be okay. So where am I going with this? As we talked about, bubbles and whether they exist or they don't exist. And of course they exist. Everything's a boom bust cycle. Nothing is stagnant, right? It's the most inefficient systems in the world. So if we look at this, everyone thinks they're efficient. They're literally the most inefficient systems in the world. But if you look at these and the spread versus where you are now, you can see that you don't really have a big spread here. A matter of fact, this spread for decades has been pretty solid. And if we are to really look at what this is telling us, well, forward earnings per share here are the highest that they really have ever been in history of this chart. So I think that this is commensurate. So why some semiconductors could be at risk, and I'm saying some, not all, especially if we have some kind of correction. Information tech, communication services, they seem to be on point. And this could explain why we're seeing some of those names. To give you an example, some names like such as a Google, which is actually still trading at a discount to the rest of the average PE of, the Mag 7. That kind of makes sense because it fits into this narrative, right? And this might be why you start seeing names like Reddit. If the PEG is there and not the PE, they might bounce because they fit into that narrative. And I'm not suggesting that one particularly, but I'm giving you an example so you can understand where my head is with this. So I do think it's worth paying attention to the disparities between the sectors as we look to see if there's signs of this. Now, what about the S&P as a whole? Does the S&P as a whole have any kind of bubble? In front of us, and we're going to look at it from an operating earnings perspective. So in S&P earnings per share, consensus analyst estimates, they're in dollar, they weekly, and they ratio the scale. All right. And so what you're going to do is you're going to have these different blue lines here, and they're going to have your 23, 24, 25, 26. And then you're going to have bottom up, meaning per company. So you take the bottom up annually when they started, saying, okay, well, where do we think we're going to be in 25, right? Like, where do we think we're going to be and where are the forward earnings? And when you see this, it's pretty impressive because really what's happening is if you say, oh, well, in 23, we were here, 24, right? Here's 25. Look at the red line. So the earnings are just knocking the cover off the ball. The forward earnings growth is just absolutely knocking the cover off the ball. And so when we look at this, we have to understand, does this in regards to a bubble, and we can all talk about PE and everything along those lines, but does this equate to something that just doesn't add up? And the answer is no. Like, this adds up. A matter of fact, if you look at the forward up, the bottom up forward numbers versus where 26 are, this to me, what starts to happen here, and I would expect this after we're through this quarter, this chart to change. And what's going to happen is they're going to have to take up their annual EPS 26 on the entire S&P. And when they do that, then they're going to justify the S&P going higher. So as always, you're in an earnings driven economy. We just are. We're not in any kind of value area. We're being earnings driven. So I fully expect that to happen on the S&P, but that doesn't mean that there's not pockets that we really have to be very cognizant of and careful of. So when we look at this growth that's happening, and the growth is really happening in the one sector, and everyone always says, oh, but it's only one sector. It's always one sector. There's always a driving force in an economy. Right now, that driving force is data centers. Some are supposed to be as bigger as cities, right? If we really look at what's going on here on the data center growth and general office office growth, you'll see where you're at. By some standards, these have already crossed. So I just want to just go through what you're looking at. General office growth versus data centers. These data centers that are going up are going to eclipse all general office growth. I think it's absolutely fascinating. And you can see this like since the pandemic and work from home, it's not like you're really going out there and building a lot of office space right now, right? But you still have a lot of office space. Look at what's happening here. And this is really your driver. Because everything that I heard on these calls, and we're going to go through some of this later, but everything that I heard on these earnings calls, and I do listen to some earnings calls, and I'd recommend that you do too, and I'm going to give you a couple that I really do think you should listen to if you have the time. They're not going away. Like these names, they're just not going away. And until that CapEx actually comes in, and I'll tell you where I think it might come in a little bit here, I don't see this slowing down. Even they're going to go stagnant on the growth versus just reverse the growth, which is what happened in 2000. I made this quick chart and I think it's pretty helpful. And I thought an easy way to do this. For me, looking at the earnings this week was more about individual names than was looking at anything else. So I want to just tell you how I see some of these names just from a fundamental standpoint, and then you guys can go do whatever you want to do with this data. You don't have to do anything with it, but I just thought this was super interesting. For me, the strong performers are here. Your challenging and disappointing names are here. Your dumpster fires with raccoons floating down the river are right here. And uranium was mixed, but I want to go through this. I don't know why this put uranium down here. I actually used AI to create this, which is pretty interesting. I used Claude to create this. I find that very helpful, quite frankly. But if I go through strong performers, D-Dog was really, they crushed, and more so than anyone expected. AppLovin, you got several upgrades there, and you want to put some time into that for sure. I mean, you really want to look into that story. I don't think that these guys could have been wronger on a name when they came out their short positions, but that's what you get. So IONQ, this was the most surprising of all the quarters that I listened to. What the CFO's doing, I would really listen to this call. I'm not a big IONQ guy or RGTI guy. I mean, I think a lot of these things are pigs. I think the real quantum is IBM personally, but what they're doing and how they're diversifying through the revenue of what quantum is going to do and how they're testing the waters in different areas is super interesting. And so this is kind of what I would call a dark horse, but you might want to look into this quarter and just pay attention to it. You can comment on this section too. This is like a newer section that I'm going to start doing because I look at what's out there from earnings, like on Earnings Whisper and things like that. And they don't really give you a good, just one line or a snapshot like, hey, this is what I think. Even if you disagree, at least you know where my head is. IREN was excellent. This to me was probably not only one of the most misunderstood quarters of the week, but this was probably one of the most misunderstood quarters of like period. The idea that this just didn't rip was just, I don't get it. Like, I understand we could talk about valuation and everything, but I literally don't get it. I'm not going to get into it all for a lot of reasons, but you probably want to listen to that call. MP was solid. And I think with the China US stuff, that makes it super interesting. Robinhood was a good quarter, but like, where are you going to go here? And you really, when we talk about PEs being stretched, it's up there. Spotify was a great quarter, but Spotify does what Spotify does, which is have a great quarter and go down for some reason. PLTR quarter was okay. The stock, the PE, all of that. I'm not a PE guy, but I mean, you get to a level here where you're looking at this and going, where are we going to go? This is supposed to be BWXT. I don't have time to change it. Just understand that. LEU was a great quarter. People are looking at these revenue streams. I didn't know that we fixed the energy issue in this country and in the world. So I was kind of surprised these things got smoked that way, but fine by me. But good quarter. And they did a secondary, and then the secondary is oversubscribed. And that's one of the reasons why you saw this bounce from 260 to 300. Just disclosure, I do own this. Challenging, disappointing. AMD was okay, but you can't be where you are and grow at 25%. So something's going to have to give here. And this is when we talked earlier about names that could be under some pressure. This to me seems like it could be under some pressure. NVO is totally struggling with what's going on with the margin side pricing of their business. VST sold off. Earnings were missed. Guys, this thing always misses earnings and then they always rally up. It's the same thing as CEG. If you go take a look at that one on Friday, I should put that in there. Moderna, they want to sell themselves. They have a massive lawsuit that's looming. And when I really looked into this, where they're trying to sell themselves, I don't know who's going to take this. It's a multi-billion-dollar lawsuit. lawsuit. And it's not just about what you would think it's about some other stuff. And I could see why they want to sell the company. But this really stood out to me as, hey, you beat, but nobody's going to buy this. I don't see anybody taking that liability. Open Door was a dumpster fire. It should have been put down here. Claude screwed up there. Why am I showing you this? You don't own a housing company anymore. Now you own an AI company. Stock. This is really what happens when you go out there and your entire business model is to hold a sign in front of Drake's house and say, Drake, say the number 82. A lot of people got smoked on this and don't realize that they just got sold a bill of goods, but it is what it is. Pins, this was just awful. Like, this was just gross. And ELF was just disgusting. So when we do earnings and we have earnings weeks, I'm thinking about doing snapshots like this on these kinds of weeks for you guys. Just let me know what you think of this and we can go from there. Now, that's going to take us to a couple places. So we have the earnings. We understand what the bubble is. We understand how to define a bubble. We understand there's no way to really identify one except past performance. We're there. If we look at Meta, which I think is a great example, I don't personally think that the bubble fits. I think that winners and losers is fitting. And what I'm really focused on is this. Meta came out on their earnings call and said, we're going to continue to spend money even though we're lowering our revenue guidance. That's why the stock is down, not because of a bubble, but because they're not winning. And it's really very simple. We all know nobody wants those goggles. But if we really look at this, that's a pretty steep move on something like that. It's 20% in a very short period of time. So sure, you're going to have some kind of bounce, but does that mean that you have the ability to put a bottom in? I don't have an answer to that. I do think some of these names are completely overbought longer term, and I do think that they could come down pretty hard. And where does this land? I really don't know. I don't really have a clue of that yet. Could you come back down to this 450? Yeah. People have to remember, guys, this stuff was at 450 and you were there in April. Could you get there again? 100%. And one of the key things that I tend to look at with this is that when I'm hitting these higher highs, I do look at the RSI because it determines the magnitude of the move, and I find great value in it. Oversold, yeah, we're going to bounce. To where? You might lift there short term, but where do you really get to? From my perspective, and we look at where you were in February, you're not really going anywhere, right? You're trading in this kind of valuation range. It's very different than some of these other winners and losers. And I'll give you an example what I mean by that. If you look at Google, ever since Google settled its case, it's been on a tear. Ever since it settled that case, it's got nowhere to go but up. And I think that's really important to get here, that it really is not doing anything except continuing to push and to win. But again, we are seeing a lot of these kind of divergences, which are setting us up and saying that maybe we're going to have a little more pain here or maybe some retest or some backfilling. Sure, we're going to have bounces and rallies. I fully believe that. But I think if anybody looked at this market, they're having a tougher time staying in their trades. And that has to do, obviously, with the government shutdown, which does hurt GDP, despite what people think. And it also has to deal with some other issues out there that we're dealing with, right? We have a couple wars going on that are still floating out up there. We have trade negotiations. There's a lot of uncertainty and people are not spending money based upon that. So when we see this, we have to be cognizant of what we're looking at. Understanding that, yep, maybe Google's not a bubble, but maybe Meta is. And I think if you start looking at it that way between the winners and the losers, you'll do yourself a better service. For example, when I listened to the SanDisk call, and this was something that I showed you guys earlier, but for now, we're just going to clean that all off. And what was important about the SanDisk call for me was demand for product was so great, just so out there, that 26 is completely sold out. And 27, they're already calling their clientele and saying that they need to do allotments. That is a very different model than saying that something's in a bubble. So why people are arguing about the valuations and we've gone from here to here, maybe what they should do is look at the earnings and seeing what's going on with these companies and going, oh, I see. It started to jump here, and this is where you raised your revenue and your earnings because you beat your earnings by 522%. Is that a bubble? It sounds like a solid business. We were supposed to earn 88 cents. We earned $1.22. So even after you raised your guidance because you beat by 500%, you took it up and you beat by another 40% because you raised your gross margins from 30% to 40% because there's that much demand that you're sold out for the next, 18 months to 2 years. That's not something that you'd wrap your noodle around and say it's a bubble. If I look at something like IREN and their conference call, which is probably another one you might want to listen to, I would have to go out there and say, oh, this was pretty an interesting conference call. They have a $10 billion deal with 85% gross margins, meaning $8.5 billion of pure profit. Oh, the company's trading at $16 billion and they just got that contract. And then I would look at their revenues and go, okay, well, they're doing 240 a quarter or $1 billion, and this adds $2 billion a year to their run rate. Okay, that's that kind of thing. That doesn't seem like a bubble to me. The bubble to me is the dumb stuff. And there's no other way to say that. But if I have something like an RGTI, which I know people love, and I look at this corporation and go, okay, I'm doing $1.8 million in revenue a quarter. Oh, they must be growing. The estimate's coming out. Okay, it's 2.1 is what they're going to do. All right. Well, what they do before, 1.4. All right, so they missed. Okay, so this better be like the mother of dragons of all quarters. Or this RGTI, this particular one could be in a bubble. Whereas if you listen to the INQ quarter and how they diversified out their revenue stream, which is why they're up 50% on revenue, well, that's not a bubble, right? So I think that looking at these technologies and deciding who the winners and losers are by looking at how they're performing on their earnings and the growth and what they're saying is the cleanest way for you guys to determine what is a bubble and what isn't a bubble. And that's the difference between going out there and getting involved in something where you can do exceptionally well, where you're buying a NVIDIA. And if you were in NVIDIA when it started and everybody else said, oh, it's a bubble, you remember those people back here that told you CoreWeave was a scam and they were jamming all that stuff into them, right? Now you don't really know who those people are that were on Twitter anymore, do you? Remember they said that about CoreWeave and then the thing opened at 37 and went to 180? Does that really seem like that was a bubble for NVIDIA? No, it's just that they have a product that people want, that product that they still want. So this wasn't a bubble, but something like OpenAI, which is now what the name of the company is, right? Which is kind of interesting that they're going with the name Open and then they want to be called an AI company. I'm making a little joke there. I thought it was funny. That no, they don't want to be in real estate anymore, even though they told you that it was unlimited potential in here for real estate, right? Now they want to be what? Open AI. Okay, I'm sure that's a coincidence. The problem here is the difference between the fervor or excess of a market and what this brings. This is no different than when Amazon came out and corporations like Books A Million that were out there absolutely exploded because they came out and said, me too, we're going to sell books on the internet too. And one is $1 trillion company and the other one is no longer around. It's up to you to understand the difference and the nuances of what's going on here. I have no doubt that this market is going to trade all over the place. I have no doubt that you're going to have massive, massive drawdowns in this market as this all sorts itself out. But I just want to show you something and so that you understand this because I think it's important. And yeah, I know that I could have clicked this button, but I think it's more important and more poignant to go through time. If you sit here and look at this and understand all these nuances, in 99, we were told that was it. That's the end of it. Yep, I hope you got out because, from here on out, you're just not going to make any money, because that's your top right here, July 99. And then you had a drawdown of like 15%. And then all of a sudden, what happened from there? And if you look across from there, from 63 up, you went up over 100% on the market. So the idea that you're going to be able to determine this is only going to be by determining what's actually going to move it. And the only way that you're going to do that is by doing constant analysis and doing due diligence. And quite frankly, you're never going to be right 100% of the time. So you have to go out there and keep drilling into the individual companies and make your own informed decisions. That's it.